Are you ready to grow your business from 100 million to 250 million? Hey everybody, I'm Thomas McMillan, and today I'm excited to be able to host our final episode in our series, From Startup to $250 million, how to use finance and accounting to grow your business. I'm excited to be able to introduce our guest and featured speaker today, Rourke. He's the CEO of Rourke. How are you doing today, Eric?
I'm doing fantastic, Thomas. Thank you. And I got to tell you, 100 million, that is the big time now. That's quite a bit of dollars and people and locations all going on.
That's a big company. So let's dive right into how to use finance and accounting to grow these companies from 100 million all the way to 250 million. You ready, Eric?
I'm ready.
Last time we talked about people, process, and technology. Let's dive into people. What's a big change whenever you're going through this growth?
First of all, Thomas, obviously when you're going from 100 million to 250 million in revenue, 100 million is just a big jump already. There's a lot of things that are changing. But when we look at that bracket, that's 2.5 times the revenue from start to finish. So the first thing that's going to happen is your team's going to grow tremendously to be able to support that growth. So I think that's going to be really a huge change and a big focus for what you're going to want to do accounting and finance wise.
Structure wise, what do you think a typical structure might look like? And I'm sure it'll change during that time frame, but let's talk a little bit about structure.
Definitely. And things will, change. You'll put in more employees and have to have more management level, things like that. But the first thing I'll say is with structure, it's always a little dicey in the fact that depending on your ownership structure, like if you're a public company, private equity built company, ESOP, a privately held company, they're all kind of different in what their needs are and demands are. And the same thing happens whenever you get to industries. So if you take industries that have very low margins, obviously they're really trying to automate and do things differently than maybe like a manufacturing industry or construction. It's a little bit different. But when you look at this level, typically you're going to have an executive at this level. And we'll talk a little bit about a CFO and the importance about that. But then what happens is you start breaking them down into tiers. You have an accounting tier, which typically becomes your controller. You typically have professional accountants that are doing the accounting work. That's going to be your senior accountants, staff accountants, your general accounting. And then you're going to have managers over transactional departments, such as AP, payroll, AR, collections, credit. So you're going to have people managing those groups because they're going to start becoming larger and larger. Then what you'll typically have is on the other side, you'll have a finance department. And depending on your industry, it may be a larger finance department, maybe a smaller finance department. Typically in a finance department, you'll have a finance manager or a VP of finance for larger organizations. And so that's anywhere from VP of finance to the finance manager. There's a director in between. And then you have people who are doing the work. And depending on your philosophy and what you do, it could be senior financial analysts, or they could just be financial analysts, depending on your needs.
Having worked in a lot of different types of organizations, one thing you notice is as companies grow, employees typically change. What are some of the key things that you see, and changes in the types of employees that you might bring into accounting?
Yeah. So even along our last questions, as well as Thomas, and this is a great follow-up to that, is you're going to start building in specialty groups, cost accounting, project accountants. Those specialty groups are going to start coming in because you're going to have enough revenue at that level. But one of the biggest challenges that I see is, look, finding people isn't necessarily hard, but finding good people is very difficult, right? And as you're going to grow, those teams are going to need to expand. The better people you have, the better systems that you have, obviously the less people that you'll need. That helps with the profitability of the company. We talked a little bit about accounting and finance, but this is an area where you really probably want to start looking at bringing on a recruiter to be able to help you find these good people. Now, look, if you're in a company and your main business is manufacturing, your HR and internal teams are probably really good at finding people on the shop floor, right? Construction, they're probably typically good at finding construction workers, or aerospace and defense usually are pretty good at finding good engineers. But when you get to this accounting and finance, there's not enough of it, right? There's not enough volume to stay up on the market and stay current. It's like technology, right? If you're not staying abreast of the latest and greatest things, That's why I love my IT firm that I use. They're absolutely amazing. They're staying on top of all that stuff. And even though I'm a fairly technical guy, but your recruiters really should be consultants. When we talk to our clients, it's not about putting people in front of them. It's really about being that partner to work with them and help them on what's the current trends in the market, what are the skills that they're looking for, even helping them structure. So we even say, hey, have you thought of these types of structures? And you get so much bang for your buck, and getting the better people that you typically get with a good firm is so well worth any kind of fees that you pay. I've seen it on the CFO side when I was a CFO. I got to tell you, it's even more transparent to me as I see it over larger data sets myself of getting those good people in there are just can be game changers for the companies, especially at the management and the executive levels.
Having firsthand experience in helping these companies bring in the right people, what are some of these really critical skills that people in this accounting and finance have to bring to the table as you're really at this $100 to $250 million range? Can you talk a little bit about the skills they're going to have?
Yeah, this is where that consulting advice really helps. So when we look at the 100 to 250 million, things are going to change. What you're going to have to do is, instead of doing as much manual things, you've really got to rely on systems, processes, internal controls. And so first and foremost, the folks that you're going to want to bring in are going to want to have good system skills, because at this level, you should really be leveraging your systems. If you're not, you're leaving a lot of profitability on the table. We see a lot of our clients who are really prizing skills in Excel. It's amazing what can be done in Excel and the skills that are out there, even though our recommendations are at this level to try to move away from Excel and simply use the systems themselves. That being said, the competency behind that is really being able to handle large data sets. So it's one thing when you have 200 lines of information. Now you might be 2,000 lines, 20,000 lines of information, 200,000 lines of information. And companies running, that's where you see companies will use SQL, will use Power BI, other reporting tools, Tableau. There's several of them out there. It's to handle those large data sets. And in order to do that, your professional has to move from having that Excel-minded sheet where they manipulate data to having a database mindset. How does this information go in and out of the database? Like, how do we input it? How do we store it? How do we retrieve it? And how do we present this information? Because now it isn't doing a whole bunch of manual work. Now it's really leveraging the system in order to do it. And I got to tell you, when we get to this level as well, it's not one office location or another one down the street. Really at 100, 200 million, again, depending on your business, your industry, you're looking at multi-offices, multi-state locations. It's very common to start seeing international operations at this point. So you've got to not only be able to handle large data sets, but be able to work in different and remote environments. And that brings up my next point. Communication is key. Communication is always important, but whenever you get across and have a bigger span and you're not in the same areas, communication are so important, not only to other employees, other departments, but moving communication up the executive level team.
I could see just the sheer number of people and keeping up with those communications just by itself. That's a major undertaking in and of itself as you grow those teams. Speaking of, as you think about accounting, what specifics are there that your organization has to be, and your people, I guess, have to be really well versed in? Hard skills within accounting at this point.
Yeah, sometimes we call these technical skills as well.
Yeah.
There you go. But if you haven't, at this point, a lot of businesses will hang on to cash basis accounting that works for certain companies because of tax purposes. But really at 100 million, this is really at the point where you've got to move to accrual or GAAP-based accounting. Don't worry, for all of you companies out there that still want to do tax basis or cash basis tax returns, your CPAs are really versed at making those adjustments, but you really want to move to accrual or GAAP basis financial statements. And the biggest reason why, Thomas, to me, is from the internal management reporting perspective, is it takes out all the noise, right? So if you look at your P&L, and one of my favorite ones is I was sitting down with a business owner and we're getting them ready to sell. We're looking at their trends of EBITDA, right? Mm-hmm. And we go, oh gosh, April was terrible. Like, what happened in April? And we're looking at the sales and we're looking at everything. And it's like, we get to the expenses. Oh, there's 3 payrolls in April. Well, they only booked payrolls based on when they were paid. So it made April look like a really bad month, but April wasn't a bad month. When you took that payroll out, April was actually a good month. It was the March that was actually not a very good month, but it looked really good because it didn't have a payroll accrual in there. So I think that's important because you can really measure, it really puts things in the time period where they occur, right? So your revenue and your expenses are matched. But even more, well, just as importantly, moving to GAAP basis financials. At this level, you're going to need to borrow for growth. I mean, hopefully. And you know the old adage, if you're not growing, you're dying. But usually you have a line of credit, you're buying equipment, you may even be buying facilities. So all the banks, the financial institutions are going to want to see GAAP-based financial statements. And at this level, probably a review or an audit, just depending on the amount that you're borrowing. If you're looking for any kind of investment, partnership, even what they call mezzanine capital, which will help you with growth and M&A, they are looking for GAAP-based financials. And your CPAs are going to be the ones doing the audits that they need or reviews. And so all this is going to culminate into really needing that GAAP-based financial information. Now's the time because you're large enough to make that change. If you haven't already, I would encourage you to even do it before this. But if you haven't already, now's really that time where we see companies, if they don't do that, an event comes up and it actually is an opportunity that may be lost or they might not be able to reap as much out of it.
So with all that change, just having people who understand it, that's critical. We talked earlier about like the finance and accounting becoming different groups. How might things change with people like different types of ownership structures?
Yeah, certainly. So in accounting and finance too, as being separate, first and foremost, what you're going to do, and we'll apply these ownership structures, is your accounting group is really good at reporting the numbers, reporting what happened, and getting them in the right buckets and information so it's accurate. Your accounting group should really be good at reporting internal information to help your management team. And then your accounting group, as you grow, acts as your finance department, but it is very different, right? And at this level, 100 to 250 million in revenue, there's so much transactions that are going on, so much money that's taking place. Now, if you even find a little change that you can make, it becomes significant over the volume that you're doing, right? So if it's 1% over 100 million, it's a lot of money. I can do the math there at 1 million. That's huge to the bottom line. So the finance team has a separate skill sets. They're going to be digging in, giving you projections, giving you information to make better decisions, and that will be affecting your bottom line. Even though your accounting group can do some of that and probably has done some of that, they are experts in that, and they're going to bring strength and value. It's kind of like if you go out and you go to an ice cream shop, or if I go to the grocery store, they have all sorts of ice creams out there. But I got to tell you what, there's nothing better than my local ice cream shop that goes out and makes it there. It's nice and fresh, or even homemade ice cream. It's just very specialized and very different. When we look at like the requirements, and let's map some of that back to the requirements. So if you're a public company, Thomas, you're going to have to be GAAP compliant and very strong, because not only now are you measured to the GAAP compliance, you're measured to preparing that in the SEC formats and knowing what the SEC reporting is, the deadlines, and there's more than just accounting that goes into that, but the accountants are typically responsible for that. Now you're even responsible for the internal controls. So depending on your level of market cap, you're required to attest to the internal controls, and your audit firm comes in and does an audit of your attest, right, of what you say it is. And to make it even more fun, your CEO and CFO or Chief Accounting Officer sign the 302 and 906 certifications under Sarbanes-Oxley that says we'll be personally liable or criminally liable. So, which breaks that kind of corporate veil of corporate protections. Your private equity-based companies are really going to want to know. So they're going to have maybe less stringent reporting requirements than a public company, but I would say similar, because you have external investors. Anytime you have external investors, it ramps up the reporting, but they're going to be very focused on the analysis. How do you maximize EBITDA in the company? What's the strategy, and how do we build the strategy going forward? When you're in a privately held company, at this point, you're going to want to make the breaks, and you're really going to want to put the team in place to be able to really get you to where your goals are at. And there's so many dollars. A lot of the owners want to start taking a step back at this point, or they may have taken a while to accumulate the company to this level. So you need to make sure you have strong people in that organization for the second, for the third generation, and even to enjoy some of the fruits of your labor.
Let's talk about like how the management team itself changes. So we talked about just the normal, people, but like, what about the management team? What's different?
Yeah, the managers have to think differently. And unfortunately, Thomas, what we'll see is that skills have to be upgraded as you hit certain breaks in revenue, which goes along with kind of our series of what we've been doing. But when you're at 100 million in revenue, unlike say $1 million in revenue, you can't throw people at the problem, right? The problems become too big. It's too many transactions. So you have to really rely on what they call routine data processes, is what Ernst & Young taught me. The high volumes of transactions that are recurring daily, you got to make sure that the controls are in there, that the processes are in there, the internal controls are in there to prevent or detect issues, right? And then that way you minimize the corrections and the people that you need. And if you don't have people that are thinking that way, they're thinking about, hey, we'll just go in and manpower fix it. There's just too much data, too much information. You're going to lose because the company's going to way outnumber the accountants. And if not, that's a problem for another day. I'll tell you too, one of my biggest mistakes that I made as the CFO, a lot of this had to do with budget, but you've heard of stepping over dollars to pick up pennies. Not my case, but with some of the management team, is if you have projects, use consulting. Your team is typically at 90%, 100%, maybe even 110% of their capacity, right? A lot of companies don't invest in additional capacity in overhead functions, whether it be accounting and finance, HR, or IT. So if you have a project like an ERP implementation or an acquisition, you've got to bring in people to help manage that project. Otherwise, they get extended, it gets more expensive, there becomes failures. And that's where I talk about the picking up pennies to step over dollars, is you think you're saving money in the short run, but your cost in the long run is tough. And then there's all sorts of protections as companies grows from the HR perspective. So people that are on leave or have left, the more employees you have, the higher chance you have of people leaving. You really want to look at putting in an interim person. Biggest mistake that we see companies make is they rush to hire because they have an open position. And we've seen that cost them tremendous amounts of money. And from your management team, we need them, again, focusing on the processes, the internal controls, not so much the doing part, which does change, right? How do we drive that? And being able to push down to managers. Your controller in a small company, you may have a whole bunch of people that are doing the functions, right? But when you get to larger companies, then they have to have managers because there's so many people who are doing it. The management span of control gets imbalanced. And look, at this level, as we're talking about it, leveraging technology for efficiency, that's been one of my mantras to being able to save money as much as possible. Let's not throw people at the problems. Let's really start using technology. And now that you're getting large enough, you can really invest in those things you couldn't when you were smaller. And that's the important thing, is setting up the technology and building an efficient and winning structure. That's what wins the day. And that could save you substantial money in just accounting and finance alone.
Mm-hmm. CFOs. We talked about the management structure, just CFO outside of the leader of the organization. What changes within, or if they haven't brought one in, what do they need to be thinking about at this point?
Yeah, I think this really depends on the structure, the ownership structure, what you're looking to do, how fast you grew, whether you have one or don't. But if you're an investor or a CEO who's watching this video right now and you don't have a CFO, my first question to you is, who's the right-hand person? If the CEO wins the lottery, or if they don't play, get hit by a beer truck, right? What happens to the organization? That CFO is usually the right-hand person to the CEO. They report directly to the board and then the investors. And it provides also a layer of protection because you have an independent party reporting that information to the most important people, whether it's the investors, owners, board. But if you have a good CFO, then they're going to be, the CFO and CEO should be attached to the hip together. And they should be really driving the success of the business. So it just becomes a complete game changer to get that CFO in place.
Talk a little bit about what the CFO is going to do, really kind of drive that next level of growth. Let's talk about once they come in, they're the right-hand person. Where are they taking the ship?
Absolutely. And the first thing I would say as we talk about that question is there's been the growing trend of CFOs for different stages of the business. And that is a wonderful topic that I love to talk about. And so it depends on what that CFO's specialty is, which is going to drive some of these things. But if we just talk a little bit more general, they're going to manage the complexity of the reporting for an entity of that size. If you're the owner, of that entity or even an investor, there's a lot of complexities that get into reporting, whether it be to your banks, your bonding companies, your insurances, your investors. There's a multitude of that. They're going to be the steward of that. The controller is going to handle a fair amount of that, but they're going to be the steward and the one that's going to make that happen. And look, when you're getting to this level, 100, I believe from the beginning, be strategic. Strategic is going to be forced upon you just by the demands of the business. And this is the person that's going to be able to get strategic in the organization. Not everybody has those skill sets. And I will say that the term CFO, I believe, has been diluted. And so what I would consider a CFO may be different than some people with a CFO title who's out there. And that's not to in any way take away from what they're doing in an organization. Really, the CFO is the strategic person, and they're helping set the direction going forward and shining that headlight instead of being the ones looking at the taillights. CFOs will typically manage multiple departments or functions within an organization. So you do want executive sponsorship or leadership to be able to help and shape those directors' next level management, whether it be accounting is very common in finance, of course, but typically they'll do IT, HR. There's some other functions that we've seen at different companies that they've taken on. But that provides that executive leadership and sponsorship and really helps grow and develop those managers as well. Whenever you're getting, and if you're not there yet, it's inevitable, but you're most likely going to have a lending or investment need. And you're going to need that representative for the organization. And the CEO is great in doing that and really being the face of the company. But the CFO is the one who comes in and validates a lot of that information with the numbers and what's been happening, the trends. And that is their specialty, is to be able to speak to that, to be able to support the CEO and help through numbers give the credibility on the vision and everything that they're looking to do. And look, at this point, you're probably going to be looking to buy companies or possibly even sell yours. We talked in our last series, it's a time to start taking on small M&A transactions. Now you're going to be growing. They're going to be bigger M&A transactions. And the opportunity for that M&A transaction to have a huge impact on the business, either positive or negative, is going to increase. So the amplitude is going to get louder. So you want someone who's going to be that specialist in there to be able to help with that. And if you're in a publicly held or PE-backed company, there's no question. CFO is a must. Anyone that has external investors, VC-backed companies as well.
I want to bring back a personal discussion we had one time. Tell me about this story with the business owner that you were telling me about in regards to CFO and cost savings.
Yeah. So my experience is being a CFO in privately held companies is a lot of time they didn't hire me quick enough. And so they left a lot of money on the table. And that was actually one of the reasons why I founded Rourke, Thomas, is like, well, geez, as a CFO, been able to go into companies and put a lot of money to their bottom line. Gosh, there's got to be a business out of this, right? And so we've done that. But I remember specifically one conversation with an owner, and great guy, incredible entrepreneur. There is not a stronger sense of entrepreneurship or visionary in anyone else I've ever met. So compliments to him. And so I got into his organization and we worked through, and I just, getting the information together, being able to present it, understand what was going on. I was able to talk and work with the management team, myself, implement initiatives. And what happened is we actually put millions of dollars to the bottom line of this company. And some of it was one time, and some of it was just residual cost savings that came through, as well as revenue opportunities, strategic planning opportunities. But I remember the business owner, I was in the organization, I think it was about year 3 or year 4, probably about year 3. And he came to me and said, "Hey, Eric, I love it when you first came to my organization, you saved all this money. The first year, you had a lot of things that you were really able to implement. The second year, you're still doing quite a bit of it. And then now this third year, it's kind of waning off. And he said, what do I got to do to get you back and motivate you and get you back into that swing of things? I thought about that for a minute. And he was absolutely right when we looked at the cost savings, because I used to present that to the management team and revenue opportunities. And when I thought about it, and I told him, I said, the cost savings I was able to do for you in the past was based on basically mistakes that were made or things that could have been done better in the organization, opportunities not realized, right? I said, today, you don't miss those opportunities. So I make you as much or more than I ever have. But the thing that happens is you don't lose the money to find out. And so if you have a good CFO, those things are going to dwindle. But what's going to happen is you're going to have cost avoidance. You're going to be getting revenue opportunities. There's going to be strategic items that you're going to be able to take advantage of. And those things don't go into a profit and loss, or they're buried into the profit and loss. They don't get pulled out. So as you get that good CFO, make sure you understand the value isn't in cost savings, which a lot of business owners or investors look at. Sometimes the bigger value is really in what they're doing today so that you avoid the costs and seek out the opportunities. So it was a fun discussion. I remember his face. It was like, oh, keep up the good work, right? And I did. And it was, I think it was a good educational time, honestly, for both of us, because it was, again, respect to him, a very good question that he asked.
So M&As at this stage, can you dive a little bit how you think about M&A in this particular stage? But maybe we dive a little bit more into it, and then we can get into process and technology a little bit later.
My first of all belief is the best run companies are built to sell. There's actually a book out there on built to sell, and I recommend reading it. But if you're running your business as prepared to sell or thinking about that in the future, assuming you're not ready to do it today, you're going to be thinking about broader things. What are things that drive my multiple, right? Building intellectual property, looking at concentrations, expanding geographically, putting platforms in that are going to accelerate growth. These are things that you look for the multiple. On the EBITDA side, what are ways that I'm driving profitability and efficiency? You're going to want to do things that are long-term gains and just running your business like a business. There's a lot of owners that will run a business and they get to when they get very comfortable, have that drive, have that continue go about it. And then the disciplines and the reporting and what you're going to have to go through for the due diligence process as an owner, that should make you sleep better at night. Because if you have that dialed in and you're able to do that, means you're doing all the things right. Because a lot of times they're looking for things that aren't right, that are going to diminish the value of the company or potentially cause liabilities in the future. So I would say pro tip number one, run your company as if you were going to sell it. Pro tip number two, I think I mentioned this earlier, the acquisitions are going to be larger, riskier, more expensive. You're going to need more capital to execute them for the larger acquisitions. You got to get it right. We've seen acquisitions nearly take down companies, really set them back for a number of years. We've seen acquisitions streamline companies, great strategic purchases that really moved companies forward. You got to get it right. So you got to get prepared. You got to get ready. And we've also seen companies that weren't ready and they lost out on the opportunities. Mm-hmm. And that becomes substantial to your bottom line. But more than anything, be prepared. So if you don't have it in place already, have your team of attorneys, have your investment banker, have your wealth manager, your CPA, and your consultants. If that's what you're looking at doing, have that team in place, get them all on the same page, and make sure as they work with you, they'll be more and more familiar with your business. You'll be able to be agile, your transactions will go better, and typically go more profitably as well as a result of that. Mm-hmm. And look, if you got that team that's in that community, they might be bringing targets to you as well. So don't discount that because your network is of gold.
Yeah, especially at that point, because they know your business inside and out at that point.
Mm-hmm.
So let's shift over to process and technology, systems and processes. Any initial thoughts on what's majorly going to be changing once you get to this $100 million to $250 million, 2.5x growth stage?
Yes. First and foremost, you got to look at the systems and the process that you have. A lot of times what people will have is they'll have legacy systems, things that are kind of patchwork and put together just because they've been growing and accelerating through the growth. There's two thoughts on technology. One where you have a single provider that's doing everything. The plus of that is it's all integrated, it's all one platform. The tough part is you can't be great at everything. The other theory is the best of breed idea, which you're getting the best platform for each function of what you're looking at. But then you run into the flip side of now, what do the integrations look like? But if you have old existing softwares, legacy softwares, integrations, you're going to want to bring those together. And it's really time to be able to look at your ERP system. Is it robust enough? So a lot of people start off with a QuickBooks, a Xero, different small packages. They'll migrate to maybe like some of the Sage products or like an Intact or something like that. But as you're getting to be a more enterprise, more spread, more diverse, more automations, you're going to need to look at that. So just make sure that your systems are in place because that's a major undertaking, especially given your timeline, your horizon. And with the systems brings up the opportunities for automation. Some of these systems are meant to be automated. Some of these systems are meant to be a host of manual as well as automation. And your larger systems typically are more automated. So one of the things you're really going to want to consider if you don't have in place is what they call a business intelligence tool, which handles budgeting, forecasting. It'll handle dashboards, analytics. You're going to want to automate that process, do more if-then scenarios, because some of the strategic decisions that you're going to make are going to be so impactful and the dollars over them are going to be so huge. You want to have more and more numbers and information to be able to make those. The other thing that's actually becoming popular is robotic process automation. So the idea behind that is for these routine data processes, let's leverage the power of AI and technology and all those things in order to be able to do some of the work that the humans are doing, right? And our technology and our systems are getting there, and this is already in place today. So if you're a very large company, if you haven't been approached, you will be shortly, but this is filtering more and more down to the middle market companies, which is at this level. And a lot of people are implementing simple things as they grow, such as paperless filing systems or document management systems. And some of these systems do OCR, things like that. Just an example of some of these softwares like Blackline. Blackline will help automate the close process. It'll help automate bank reconciliations. There's ways to automate payment functions, get rid of manual checks and collections functions. Electronic payments are becoming more and more popular, and the softwares for that. We're getting away from, with email and this automation, debit cards, we're getting away from the post office. And that causes a delay in things, and business happens in real time.
A lot of new things that are taking place in this, especially it's coming down from the enterprise, but it's becoming widely available for companies. And this is a great segue of companies from 100 to 250 million to take advantage of these technologies.
Yeah, Thomas, what you're seeing is you're seeing the technology start to replace the manual work that we were doing. And what we're doing here in the US is we're looking to upskill and upscale our professionals to do more exception work, analytic work, and those type of things. And when you're getting to that 100 to 250 million, it's an exciting time because the revenue size is really at the point where you can start taking advantage of these technologies, which really accelerate your business. And it's a very exciting time. And this area, I love just talking about all the opportunities that are there.
So this series was from startups to $250 million. Do things change after 250 million as well?
Absolutely. They're changing all the time. Your breaks become a little bit larger as you go through. Your next break's going to be from 250 to 500 million, things that you're going to look at. One of those things is you're going to start bringing a lot of specialists to do things. Our clients 500 to a billion have different challenges. And then once you get beyond a billion in revenue, it is a completely different ball game up to Fortune 500 companies. So yeah, every stage has its own intricacies. I know we looked at in this series of from starting up to getting to a strong middle market company, and that's been exciting. Those are the fun times. A lot of change, lots going on, a lot of upscaling, but this is your baby and it's growing up.
Yeah.
Whether you're an owner, investor, or part of the C-suite.
Thank you so much, Eric, for all of the knowledge and wisdom that you shared with us as we navigated that journey, all the way from when we were just thinking of what to name our company in that startup phase, all the way up to this $250 million mark, and then how we could use finance and accounting to grow our business. Any parting words before we close off for this series?
I just go back to investors, entrepreneurs, C-suite executives, everyone that's involved with business. My joy and my fun is helping grow businesses, help people achieve their dreams. And just along this journey, there's so many rewards and so many things that happen. And I just wish you the most success and bless you for what you've achieved.
Well, thank you, Eric, once again. This has been from 100 million to $250 million, how to grow your business using finance and accounting. If you didn't see any of our other episodes, we also had from startup to 1 million. We had from 1 million to 20 million. We had from 20 million to 50 million, and also from 50 million to 100 million. So I encourage you to go watch any of those episodes. And thank you so much. We will see you again soon.